My presentation is actually on fiscal rules at subnational level and looking at the international experiences. And what Ela said earlier, which is about looking at the cyclical fiscal policies in emerging markets. This is the subject of our next fiscal monitor, which is going to be out in April. So actually Xavier, one of my colleagues who is here, is actually overseeing that project. And that issue of the fiscal monitor will be extremely useful because we are looking at the automatic fiscal stabilizers across different country groups, so advanced and emerging markets. So you will find that issue particularly useful as and when it comes out. So let me start with my presentation. Here I have divided this presentation into 5 parts. First, essentially provide a rationale why central governments try to constrain the spending of subnational governments. And how do they go about doing it? And the third is what are the different dimensions and facets of subnational fiscal rules? Some of the questions which were posed by Ela for the fiscal rules in general, they come up again in the context of the subnational governments. And then very quickly summarize what is the impact and effectiveness of subnational fiscal rules as one can decipher from the literature and from the experiences of different countries. And finally, what are the lessons for us when we look at fiscal rules for subnational governments? So why constraint why constrain subnational governments? So there are 2 reasons why one looks for some kind of restraint on the behavior of subnational governments. One is to eliminate deficit bias, that is the tendency of the subnational governments to overspend, undertax, overborrow. And that arises from the expectations by the state governments or by the subnational governments that somehow there is a bailout provision available from the central government. And then there is the other aspect, which is that there is a tendency to finance some of the marginal expenditures from the central government transfers, which then are made possible through taxation of the other subnational governments. So there is this issue which is labeled generally in the literature as a common pool problem. So that's the other reason why there is a deficit bias. The other reason why one needs to constrain subnational governments is to minimize coordination failures or negative spillovers with regard to the central government. It's possible that the fiscal policy which is being pursued by the subnational governments is not consistent with the fiscal policy being followed by the national government, which would jeopardize the stabilization function of the national government. The other is the horizontal spillovers, which can arise when if one state borrows too much, then it affects the market borrowing capacity of the other states, or if it spends too much and it has to be rescued by the central government, then the taxation that has to be levied to cover the cost then has to be borne by every state. Similarly, if it leads to inflation, that means all the states have to bear the cost of this policy. So how do you constrain subnational governments? So I, in the slide, have put forward a typology in terms of different restraints that one could have. So they go from less subnational autonomy to more autonomy. So the first one is a direct control by the center. In the case of India, it is with regard to the borrowing by the subnational governments. And then comes fiscal rules, which could be imposed by the center, or they could be self-imposed or negotiated with the center. And then comes cooperative arrangements, which are common in a couple of countries, Belgium, Australia, and I think Austria. There are 3 countries. It will come up again in the next slide, where the subnational governments have a lot more freedom to negotiate their fiscal targets on a continuous basis, and that gives them the maximum freedom. So if one moves from left to the right, the left direct controls give very little freedom to the states, whereas the rules can be designed in a way that there is some inbuilt flexibility, so there is some freedom, and whereas cooperative arrangements give a lot more freedom. And then, of course, on the right you have no formal sort of rule which is there. The discipline is imposed by the market, which is the case in a number of states in the US and Canada. So what is the evidence? What kind of constraints do we see in subnational governments? We see that looking at about 13 federations across the world, 90% of the restraints are in the form of fiscal rules. And then you have some direct controls and few cooperative approach kind of rules. What seems to be the case is that countries which have cooperative approaches seem to rely less on fiscal rules. So that's, again, something which can see from the 3 country examples that we have on the slide. So what are the various facets of the rules? I think it will be interesting to see some of the features. The first one is that in many countries, these rules are self-imposed. For example, in the US and Switzerland, and in case of other countries like EU and some unitary countries, they're imposed from the higher level of the government. And if one sort of looks at the division across different types of rules, they're roughly divided between self-imposed and those which are imposed by the higher level of the government. So just to be clear as to what the rule is, the rule basically imposes a long-lasting constraint on fiscal policy through numerical limits on budgetary aggregates. And the purpose is to limit discretion of policymakers and to contain pressures to overspend. And so they serve as a signaling device to anchor expectations and to communicate policy clearly to the population, thereby reducing some uncertainty. But this is just to sort of go over what we are trying to achieve through fiscal rules. This is an important aspect. I will bring it up again later, which is there are some prerequisites of subnational rules. One is that you must have a sound fiscal management practices to be able to monitor, to be able to implement subnational rules. You need to have shared in the budget formulation process, shared medium and long-term fiscal objectives. You need to have shared macroeconomic and fiscal projections. You need to have timely fiscal reporting, timely consolidation of accounts, and there should be a central government monetary mechanism to, as in case of India, to monitor the borrowing by the states, which was not the case in case of China. And we know in the last couple of years they had tremendous issues on that front, and they had to then revise upwards their debt to GDP ratio once they started to identify the excessive borrowing and the resulting debt at the subnational level. Then you need to have common budget classification and accounting standards. And of course, intergovernmental fiscal bodies which help share revenues and deal with other interjurisdictional issues is important. So this is just to indicate that to be able to implement fiscal rules, having a working public financial management systems is absolutely crucial. And I will come back later to present some examples from countries where this was not the case and they were not able to implement the rules very effectively. Ela mentioned some of the issues with rules. I don't need to go through them, but I just put it here for the completeness sake. And you can have 4 types of rules: debt rules, budget balance rules, expenditure rules, and revenue rules. Each one of the rules have problems. And what this slide does is to explain what kind of issues arise. The debt rule, of course, sets an explicit limit for public debt, and it's a direct link to debt sustainability. It's easy to communicate and monitor, but it is also pro-cyclical, the point which I think Ela was making, and the same issue arises with budget balance rules. I'm not going to spend too much of time on this part because it's quite familiar to people here in this audience. So what do we see in the 13 federations that we looked at in terms of different types of rules? What one sees is that fiscal balance is the most commonly used rule in those 13 countries. In most cases, with the exception of 2, it's a rule. In others, it's in 2 countries, Austria and Belgium, it's a cooperative arrangement. And then comes, in terms of importance, borrowing and debt. Revenue rules are relatively scarce. Again, it depends on how you define the revenue rule. OECD defines differently from us, and therefore then you end up with a lot more rules on the revenue side. But if one looks at this this classification, then revenue rules are less common as compared to fiscal balance rules. And so let me, one thing that has happened in Europe is that after the crisis, with the new fiscal compact and some of the changes which have happened, and my colleague Xavier will talk about the experience with fiscal councils, which is part of the new framework. So what has happened to fiscal rules will be interesting to see in the European Union. And what this slide does is to show that between 2000 and 2011, 2000 is the blue bar, and 2005 is the red, and the green one is 2011. You can see that the number of rules, especially at the local level, have increased quite substantially in the European Union member states. And that hasn't happened at the regional level, which is the states. And what is not coming here, which should have been here, and for some reason it's not showing up in this slide, is that the most of them is actually, if I remember correctly, is the budget balance rules, where I need to make sure that I don't. Yes, the budget balance rules. The first 2, yes, is the budget balance rules, which is where there's an increase consistent with the previous slide that I presented on 13 federations. And so, and the debt rules are the next 2, and then comes the expenditure rules. And so that's what has happened in the European Union. And the next slide shows how the intensity of those rules has increased since the crisis. So if one looks at the 2011 and 2012, the central government and the regional government rules have been made more intense, and they pertain to budget balance rules. And same thing applies to debt rules. Not much seems to have happened on the expenditure rule side. I thought this is an interesting information to look at. So what is the impact and effectiveness of subnational rules? Because this is an issue which Ela posed at the beginning of her presentation. So the evidence for this is very hard to decipher from the data sets that we have, mainly because there is a very short history that is available. There are very few countries which have had rules over a very long period of time, and then there is the issue of reverse causality. Countries that are facing a fiscal crisis are likely to strengthen fiscal rules. And there is also the issue of simultaneity bias, which is rules are introduced together with other reforms. So that makes the exercise of trying to figure out the impact of fiscal rules on performance rather difficult to gauge. But there is huge amount of literature on US and Switzerland, which shows that there is a positive impact on fiscal performance and market discipline of the subnational fiscal rules. For the EU, there is growing literature, but the results are mixed. Some work done at our own department shows that there is little impact of fiscal rules. And a very recent paper that came out a month or two ago for the EU shows that the impact is positive only in unitary systems, not in federations. What has the major impact is the whether there is a vertical imbalance or not, whether there is some autonomy. How much revenue they are allowed to raise is a major factor in having an impact on the effectiveness. So then for the emerging markets, again, for Brazil, it's inconclusive because rules were introduced during debt crisis jointly and then were preceded by other reforms, so that makes it a bit harder. But there are a couple of things that come out. Their design matters. The coverage of the budget. Failure to include some sub-enterprises in Spain or special funds, as in the US, as part of the budget balance rule, led subnational governments to rely on these sources for additional funding. And I'm sure that is the case in many Indian states. And then there is this big debate, and we know that from our experience. The golden rules can be circumvented if investment is not well defined. There's a lot of accounting gimmicks that go on. In case of Mexico, the issue arose also as to how to define depreciation, because that can also have an impact on the investment, on the net investment. So then the other thing which comes out is the rainy day funds, which have been used in the US states. They do provide some flexibility and they allow smoothing of spending. They were introduced in the 1980s, and they are not they are pretty effective in helping states to smooth spending. Then the legal basis and oversight, the budget balance rules, which are enshrined in the Constitution, as in the US, and enforced by independent courts or independent fiscal councils, tend to have a favorable impact on fiscal deficits. And then the point that I had made earlier about public financial management, when the states adopted common standards of financial reporting, it improved the effectiveness of fiscal rules. This was the case for both advanced and emerging economies. And what we found recently in our dealings with a couple of countries, and I gave examples of two of them, when there was poor budget execution by subnational government, bad fiscal reporting, and insufficient oversight, it compromised the monitoring and compliance of fiscal rules. And that was the case in Indonesia and very recently in Portuguese municipalities where we provided some advice. So uniform budget procedures and strong sanction for non-compliance have been necessary with improvements in subnational performance, and this is the case in Brazil. We know that things improved there, but it's still that we need to have evidence for a longer time period. Basically, the impact depends on the design of the fiscal federalism framework. If that is flawed, fiscal rules are not going to be able to do much. And in the case of the US, one thing we've learned is that the non-bailout clause has enhanced the credibility of fiscal rules. Now, before I conclude, I just want to sort of draw a few lessons as to how one should try to design fiscal rules at the subnational level. The coverage should be comprehensive in terms of the budget. They should be flexible and they should be enforceable. In terms of coverage, they should apply to all categories, current and capital. And to the extent possible, they should cover some of the sub-central public enterprises. Of course, they should be flexible to the extent possible. In the case of Germany, they have now under the new debt break rule for the lender, for the different states, they have introduced structural balances, which means they'll have to estimate this, something which is very complex for the states to do. But in Switzerland and in other places, they do have a rule of over the cycle, which is a bit more flexible than a rule which is rigid. So one way is to perhaps look at the rainy day funds as an option, and of course, as I said earlier, strong legal basis and independent oversight helps in improving the effectiveness of the rules. And then one has to also promote a sound public financial practices across the subnational jurisdictions. So there has to be a reliance on realistic macroeconomic outlook consistent with the central government, common accounting frameworks which are harmonized with the central government, statistical reporting which has to be timely and transparent, and annual reports have to be audited independently. And as I said earlier, subnational rules will not be effective if there is a flaw in the framework itself. Thank you.